What if you could trade the markets with confidence, not based on hunches, but by using a proven method that stacks the odds in your favor every single time? Welcome to the world of high-probability trading strategies, where your trades are no longer guesses, but calculated decisions based on price, pattern, time, and momentum. Most traders jump in with excitement and lose money because they never learn to recognize the high-probability setups, the ones that professional traders wait patiently for. But in this video, you're going to learn exactly how to do just that, directly from the brilliant mind of Robert C. Miner, a seasoned market expert who lays out a complete step-by-step system for trading any market on any time frame. This isn't just another book summary, it's your roadmap to smarter, more profitable trading. And you're watching this on Book Loom, the channel where powerful trading books are broken down into real strategies you can actually use, so don't blink. Because by the end of this video, you'll know how to trade with the mindset and methods of a true professional. And trust me, once you see what's inside this book, you'll never look at the charts the same way again. Chapter 1. Foundations of High-Probability Trading. Every trader wants the same thing, to win more than they lose and grow their capital consistently. But here's the harsh reality. Most traders fail. Not because they don't try hard, but because they don't have a clear, objective, and repeatable strategy. In Chapter 1, Robert C. Miner makes it clear. Successful trading is not about prediction. It's about preparation. And that preparation comes from understanding the foundation of a high-probability trading strategy. The core message? Simplicity over complexity. Miner says traders often drown in too many tools, lagging indicators, conflicting signals, and overly complicated systems. But none of that matters if you don't have a process that tells you three essential things. 1. When to enter the market. 2. Where to place your stop loss. 3. Where to take profits. If your strategy can't answer those three questions consistently, it's not a real strategy, it's a gamble. The 4 key components of a winning strategy. Miner introduces the 4 decision-making factors that form the foundation of every high-probability trade. 1. Price. Identify zones of opportunity using support and resistance levels, Fibonacci retracements, and prior swings. 2nd pattern. Understand whether the market is trending or correcting using simplified wave structures. 3rd time. Know when a market is likely to change direction based on time cycles and historical rhythm. 4th. Momentum. Confirm the strength of a move and detect early reversals using dynamic momentum indicators. It's not about guessing the future, it's about waiting for the convergence of these 4 factors. When they all align, you have a trade setup with a statistical edge. It's not about being right, it's about the odds. Miner drills down on a key mindset shift. You're not trying to predict every move, you're positioning yourself where the probability of success is greatest. It's the difference between reacting emotionally and acting objectively. The best traders don't chase the market, they wait for the market to come to them. Why most traders lose and how you won't. Most traders enter the market with no clear rules. They rely on emotions, gut feelings, or a single indicator. Miner warns, that's a formula for long-term failure. His system, however, is about discipline, structure, and clarity. And that starts by analyzing every trade based on the 4 factors we just discussed. Final insight from Chapter 1. Trading is not magic, it's a skill, and like any skill, it can be mastered with the right tools and mindset. Miner's foundation teaches you how to think like a professional trader, not someone chasing highs and fearing dips, but someone who knows exactly what to look for and when to act. But here's the big question. If price, pattern, time, and momentum are the 4 keys to high-probability trading, how exactly do you combine them in a real-world trade setup? Because knowing the ingredients is one thing. Learning how to put them together to find the perfect entry point, that's where the real money is made. Stick around. because in the next chapter, we'll break down each of these 4 factors in depth and show you exactly how to use them to start spotting high-probability trades with your own eyes. Chapter 2. The 4 key decision-making factors. So you know that successful trading is all about making objective decisions, not emotional reactions. But how do pro traders decide when to buy, when to sell, or when to sit tight and do absolutely nothing? In Chapter 2 of High-Probability Trading Strategies, Robert Miner gives us the answer. There are 4 critical decision-making factors, and when all 4 align, you've got a high-probability trade setup in your hands. Let's break down these 4 core pillars that guide every successful trade. 1. Price. The zone of opportunity. You can't know what's going to happen next, but you can know where it's likely to happen. Miner emphasizes that price isn't just a number, it's a zone where opportunities are born. He uses Fibonacci retracements and extensions to identify where a market is likely to reverse or accelerate. Here's what you need to know. Retracement levels: 38.2%, 50%, 61.8%, help spot potential pullbacks in a trend. Extension levels help project where a price may go after a breakout or reversal. These levels create high-probability zones, but you don't trade just because price hits one. It's only step 1 in the process. 2. Pattern. The story behind the move. Pattern recognition is about understanding market behavior. Miner simplifies wave theory into 2 major types. Trend, impulsive. Price moves in a clear direction, up or down. Correction, counter trend. Price consolidates or moves sideways before continuing the trend. Instead of complex wave counts, Miner teaches traders to spot whether the current movement is a motive trend or a corrective pause. Why is this important? Because you don't want to buy during a correction or short during an impulsive trend. You want to enter with the trend, not against it. 3. Time. The hidden cycle. Most traders ignore. Most traders look only at price, but Miner says time is just as important, and often the most overlooked. Using time retracements and time cycles, he shows how markets often reverse at specific intervals, just like they do with price. Example: if the previous swing lasted 8 days, the next may reverse at 8, 13, or 21 days. These time windows give you a temporal edge. You're not just guessing where something might happen, but when. Time analysis helps you avoid early entries and recognize when a trend is losing steam. 4. Momentum, the fuel behind. Every move, momentum is your confirmation tool. It tells you if price action is strong or fading. Miner uses a custom version of the dual time frame momentum strategy. He compares short-term and higher time frame momentum. When both align and the other 3 factors, price, pattern, time, also signal a trade, you've got a high probability entry. Momentum helps prevent false signals. It gives that final green light before you pull the trigger. Putting it all together, the power of confluence. Here's the big insight. 1 factor alone is not enough. 2 may be okay, but when all 4 agree, price, pattern, time, and momentum, you have a trade setup with a real edge. Miner stresses that trading is not about being right every time. It's about having a method where the odds are stacked in your favor over dozens and hundreds of trades, from random to repeatable. With these 4 factors, you're no longer reacting to the market. You're anticipating it. And more importantly, you're making decisions based on structure, not stress. This is how professionals think. This is how they trade. And now, it's how you can trade too. But now comes the real challenge. How do you take all these factors, price, pattern, time, momentum, and turn them into an actual, repeatable trade setup? In the next chapter, Robert Miner reveals exactly how to do that, step by step, including how to enter, exit, and manage risk like a pro. Chapter 3. Momentum Strategies, the fuel that drives price action. Imagine trying to drive a car with no fuel. That's exactly what trading without momentum is like. No power, no direction, no results. In this chapter, Robert Miner introduces us to the engine behind every high-probability trade setup, momentum. While price, pattern, and time show you where and when to trade, momentum tells you if the market has the strength to move in your favor. Let's dive in and learn why momentum is the ultimate confirmation tool for smarter entries and exits. What is momentum, and why should you care? Momentum reflects the speed and strength of price movement. If price is moving but momentum is weak, the move might be a trap. If price and momentum are aligned, that's when big opportunities appear. Miner says most traders misuse indicators like RSI, MACD, or stochastics, looking for overbought or oversold signals. But that's not how pros trade momentum. He teaches a unique momentum model built around dual time frame analysis, momentum trigger reversals, specific setup bar patterns, dual time frame momentum, your edge in the market. This is the heart of Miner's momentum strategy. First, look at momentum on a higher time frame, like the daily chart. This gives you the trend context. Then, look at momentum on a lower time frame, like the 4-hour or 1-hour chart. This gives you the entry signal. When both time frames show reversal triggers in the same direction, Miner calls it a dual time frame momentum setup, and it's one of the most powerful confirmations for a high-probability trade. Trigger reversal bars. Your precise entry signal Miner introduces the momentum trigger bar, a specific candle or bar that signals a momentum reversal. Here's what to look for. The bar must reverse direction, from up to down or vice versa. It must close beyond the midpoint of the previous bar. It often coincides with a price pattern reversal or Fibonacci level. This bar is your entry trigger. When it forms after a price, pattern, and time setup, and momentum agrees, it's time to pull the trigger. When momentum diverges, use it to your advantage. Sometimes price makes a new high or low, but momentum doesn't follow. That's a divergence, and a huge warning signal. Miner says divergence is one of the most reliable clues that a market move is weakening. He teaches traders to spot bearish divergence at tops and bullish divergence at bottoms, especially near Fibonacci targets and time cycles. This lets you avoid false breakouts and anticipate major reversals before the crowd sees them. Momentum isn't just for entries, it's for exits. 2. Momentum can also guide your exit strategy. If you're long and momentum starts showing bearish divergence, it's time to lock in profits. If momentum flattens while price hits a key level, you might want to tighten your stop. This makes your trading smarter, more precise, and less emotional. Key takeaway: momentum is your final filter. Miner's golden rule: never take a trade just because the price setup looks good. Only act when momentum confirms the move. Momentum gives you confidence. It's the difference between guessing and knowing when the market has the energy to move. By combining price, pattern, time, and momentum, you now have a 4-lens system that lets you see the full picture before placing a single trade. But even with all these tools, one question remains. When exactly should you enter a trade? And how do you manage your risk like a disciplined pro from the moment you click buy or sell? Because in the next chapter, Robert Miner reveals his complete entry strategy, step by step, along with where to place stops, how to trail profits, and how to make your trades stress-free and systemized. Chapter 4. Price and Pattern Strategies, the blueprint behind market moves. You've probably heard the phrase, the trend is your friend. But how do you actually recognize the start of a trend, or the end of one, before the rest of the market does? In this chapter, Robert Miner teaches us how to use price and pattern strategies like a market architect, so you're not reacting to the market, you're anticipating it. Price strategies: why levels aren't enough. Price is where most traders focus, but Miner warns, just knowing the price isn't enough. You need to understand price relationships, especially Fibonacci retracements and extensions. Here's how Miner breaks it down. Retracements: 38.2%, 50%, 61.8%. These are potential support/resistance zones during a correction. Extensions: 127.2%, 161.8%, 200%. These help forecast where the market might accelerate or reverse. But Miner doesn't stop there. He looks for clusters, areas where multiple fib levels from different swings converge. That's when price becomes truly meaningful. A Fibonacci cluster is a hot zone, and if pattern and momentum confirm, you've got a high probability setup. Pattern strategies: recognizing market intentions. Price tells you where something may happen, but pattern tells you what is happening. Miner simplifies pattern recognition into two categories. 1. Trend, impulse. Patterns: these are strong directional moves, usually in 5 waves. They tell you the market has conviction, and you want to trade with them. 2. Correction, counter-trend. Patterns: these are pullbacks, pauses, or sideways structures. They usually unfold in 3-wave moves like ABCs, triangles, or flats. The goal? Identify when a correction is ending, and get ready to jump in the direction of the next trend leg. But here's the kicker: you don't need to label every wave. Miner's approach is practical. He teaches traders to spot the rhythm of market swings, rather than obsess over perfect wave counts. Combining price plus pattern equals market blueprint. This is where the real power lies. Miner shows that a price zone, Fibonacci cluster, combined with a pattern completion, like the end of a correction, often signals a prime reversal point. Examples: if price pulls back to a 61.8% retracement and completes a clear ABC correction pattern, get ready for a trend continuation. If price extends to a 161.8% level and forms a 5-wave ending move, that may signal trend exhaustion. Now add time and momentum to this structure, and you've got a blueprint for high-probability setups. Real-world application: simplicity over complexity. You don't need 20 indicators or perfect wave counts. Miner's method is about clarity. Identify price zones using Fibonacci. Read the pattern. Is it impulse or correction? Wait for time and momentum to align. Then, pull the trigger. It's simple, logical, and powerful. Key insight: patterns don't predict, they prepare. Miner stresses that pattern analysis isn't about predicting the future. It's about preparing for the most likely outcome and having a structured plan when the opportunity appears. That's what separates amateurs from professionals. Pros don't predict. They prepare, wait, and act with precision. But here's the big question. Once you've identified a high-probability setup using price and pattern, where exactly do you enter? Where should your stop go? And how do you avoid getting shaken out too early or holding on too long? Because in the next chapter, Miner gives us the complete trade entry and trade management blueprint, including exact steps to protect your capital and maximize your profits without second-guessing. Chapter 5. Time Strategies. When will it happen? Price tells us where the market might go. Pattern shows us what the market is doing. Momentum tells us if it has strength. But the one question every trader still has is, when? In this chapter, Robert Miner reveals one of the most overlooked yet powerful factors in trading: time. Because knowing when a trend or reversal is likely to happen gives you an edge that most traders never even consider. Why time is the missing link in most trading systems. Most traders obsess over price, but Miner argues that's only half the equation. He says price and time are equal factors in identifying market turning points. In fact, many failed trades don't fail because of the setup. They fail because the trade is taken at the wrong time. When you understand time cycles, you no longer feel like you're chasing the market. Instead, you learn to wait, patiently, for the market to come to you. Introducing time clusters, your forecasting weapon. Just like price can form Fibonacci clusters, time does too. Miner teaches how to analyze time swings between major highs and lows using Fibonacci ratios such as 100% equal swings, 127%, 161.8%, 200% extension time projections, 61.8%, 38.2% retracement time zones. When multiple time projections from different market swings converge on the same date range, Miner calls it a time cluster, and this is where the market is most likely to make a turning point. Time is not date forecasting, it's turn zone forecasting. Let's clear up a myth. Miner isn't trying to predict the exact date a market will reverse. He's identifying a time window, a hot zone that may last 1 to 3 bars, where reversals are likely. This approach helps you avoid being early or late. It lets you focus your attention and align your strategy when all 4 decision factors, price, pattern, time, and momentum, line up together. How to find time clusters, the practical steps. Here's how Miner teaches traders to calculate time clusters. 1. Identify 3 to 4 major market swings, highs, lows. 2. Measure time between those points in bars or days. 3. Apply Fibonacci ratios to those time swings. 4. Look for overlap of projections. This is your time cluster. Once you find that time zone, watch it closely. If pattern, price, and momentum also line up, you have a high probability setup. Why time filters? Improve discipline. Time strategies do more than just mark potential turning points. They help you. Avoid overtrading. Stay patient. Focus on high-quality setups only during meaningful periods. Instead of reacting emotionally to price action, you become a strategic decision maker, planning around time like a chess master. Miner's approach gives traders something most lack: confidence to wait and clarity on when to act. Key insight: great trades happen in time. Windows. A winning setup isn't just about a price level or a chart pattern, it's about all 4 factors lining up, especially within a critical time window. That's the difference between low probability guesses and high probability precision. Miner's time strategies don't predict the future, they prepare you for it, so you're ready to act when the market aligns. But here's the next question smart traders ask. Once you have the perfect setup, how do you actually execute the trade? Where do you place your stop? How do you trail profits like a professional? And how do you manage the trade from start to finish, without emotion? Because in the next chapter, Robert Miner teaches his complete trade entry and management system, a step-by-step game plan that shows you exactly what to do once all 4 factors line up. Chapter 6. Entry and Exit Strategies. Turning setups into winning trades. You've learned how to identify the where, what, and when of high-probability trades. But the million-dollar question remains: how and when do you get in? And equally important, how do you protect your profits and exit with confidence? In this chapter, Robert Miner reveals the exact entry and exit techniques that separate winning traders from those who just watch the market. The 3 key entry techniques. Miner doesn't believe in random entries. Instead, he focuses on 3 powerful entry strategies designed to maximize reward and minimize risk. 1. Aggressive entry. Entering before confirmation, typically at the end of a correction pattern or near a Fibonacci cluster. Higher risk, but potentially bigger reward. Requires discipline and a tight stop. 2. Conservative entry. Waiting for confirmation, such as a breakout bar or a momentum signal. Lower risk, but you might miss some initial move. 3. Swing entry. Entering on a retracement during a confirmed trend. Ideal for capturing multiple moves within a larger trend. Miner advises traders to choose their entry style based on their risk tolerance and market conditions, but always with a clear plan. Stop-loss placement. Protecting your capital. No trade is complete without a proper stop loss. Miner's rule is simple. Place your stop beyond the logical invalidation point of your trade. For example, for a trade based on a Fibonacci cluster, the stop should be just beyond that cluster. For pattern-based trades, place stops beyond the last swing high or low that invalidates the pattern. He warns against mental stops or moving stops prematurely. Discipline here is key. Your stop protects your capital and keeps you in the game long term. Profit targets and trade management. Knowing when to take profits can be just as tricky as entering. Miner introduces two primary methods. Fibonacci extension. Targets use levels like 127%, 161.8%, or 200% for setting realistic profit targets. Partial profit taking. Take partial profits at early targets and let the rest run with a trailing stop. Trailing stops should be dynamic. Miner suggests moving stops up or down to break even once a minimum profit target is reached. Then gradually tighten the stop behind swing points or moving averages to lock in gains. The mental edge. Confidence through structure. Miner emphasizes the mental game throughout entry and exit. Follow your plan and avoid second-guessing. Use stops and targets as your emotional armor to prevent panic decisions. Stay objective. If price hits your stop, it's the market's way of telling you your setup was wrong. If your target is hit, celebrate your disciplined execution. Combining all four factors. Entry and exit decisions become clear when you combine. Price zones, Fibonacci clusters, pattern completions, time clusters, momentum confirmation. When all align, entries are less guesswork and more calculated precision. But here's the critical question. Even with perfect entries and exits, what happens when the market suddenly turns volatile or gaps against you? How do you adjust your strategy to protect yourself and stay profitable? In the next chapter, Miner explores advanced trade management techniques and risk control, so you can survive and thrive no matter what the market throws at you. Chapter 7. Real market examples, seeing theory in action. You've learned the powerful theories behind high-probability trades, price, pattern, time, momentum, and precise entry and exit strategies. But theory alone won't make you a successful trader. You need to see these concepts come alive in real markets, because real price action is where the rubber meets the road. In this chapter, Robert Miner takes you onto the trading floor through detailed real market examples that prove how his system works in practice. Why real examples matter. Reading about trading strategies is one thing, but watching them unfold on live charts is a game changer. Miner's real examples show how multiple factors, price zones, Fibonacci clusters, time cycles, momentum shifts, combine to create high-probability setups. You start to see patterns in chaos, turning randomness into opportunity. Example 1. The perfect confluence setup. Miner walks us through a trade where all four factors align perfectly. A strong Fibonacci price cluster marks a key support zone. A corrective chart pattern completes right at that level. The time cluster from prior swings suggests a potential reversal window. Momentum indicators confirm weakening selling pressure. The entry is timed right at the bounce, stop loss placed just beyond the cluster, and profit target set at the next Fibonacci extension level. The trade unfolds with textbook precision, reinforcing how discipline and patience pay off. Example 2. When time clusters signal a turning point. In another case, Miner highlights a market that looks weak, but doesn't reverse immediately. Thanks to the time cluster analysis, the trader knows when to watch closely. A subtle momentum shift happens right in the time window, prompting a conservative entry. This example shows why time analysis is so valuable. It keeps you from jumping in too early or chasing price. Example 3. Managing imperfect trades. No system wins 100% of the time. Miner doesn't shy away from examples where trades go against the plan. He shows how sticking to stops and managing risk minimizes losses. Plus, he explains how partial profit-taking and trailing stops allow for flexibility when the market is volatile or unpredictable. Putting it all together, these real-world examples prove Miner's key point. Success comes from integrating all 4 decision factors and following a disciplined plan. They teach you to read the market holistically, not just price or indicators in isolation. Use time and pattern analysis to sharpen entry timing. Manage trades actively, protecting capital and locking in profits. Why this chapter will transform your trading. Seeing these examples builds your confidence and practical skills. You realize it's not about luck. It's about mastering a repeatable process that works over time. But here's the next challenge every trader faces. How do you develop your own trading edge and adapt these strategies to your unique style and market? In the next chapter, Miner dives into how to personalize high-probability trading strategies so you don't just copy, but own the process and become a consistently profitable trader. Chapter 8. The Trading Plan, Your Roadmap to Success. You've journeyed through powerful concepts, understanding price, pattern, time, momentum, entry, and exit strategies. But knowledge alone doesn't create success. The real secret is having a clear, disciplined trading plan, a step-by-step roadmap that guides every decision and keeps emotions in check. In this final chapter, Robert Miner shows you how to build your personalized trading plan, the foundation of consistent profits and long-term growth. Why a trading plan is your most valuable asset. Without a plan, even the best strategies can fail. Miner stresses that trading without a plan is like driving blindfolded. You might get lucky, but you'll eventually crash. A trading plan is more than just rules. It's your daily guide for when and how to enter trades, how to manage risk and protect capital, when to take profits, how to handle losses and setbacks, how to continuously improve. It creates consistency and confidence, 2 pillars every trader needs. Elements of a winning trading plan. Miner breaks down the plan into clear, actionable parts. 1. Market selection. Choose markets that suit your style and have clear price action and liquidity. 2. Setup criteria. Define your specific signals, price clusters, patterns, momentum readings, and time clusters, exactly when you will trade. 3. Entry and exit rules. Specify your entry style, aggressive, conservative, swing, stop-loss placement, and profit targets. 4. Risk management. Set maximum risk per trade, maximum daily loss limits, and position sizing rules. 5. Trade management. Outline how you'll move stops, take partial profits, and respond to unexpected market moves. 6. Journaling and review. Keep detailed records of every trade to identify strengths and weaknesses and make continuous improvements. The mental framework, discipline, and patience. Miner emphasizes that sticking to the plan is the hardest but most important part. He advises, don't deviate based on emotion or gut feelings. Trust the process even through drawdowns. Be patient and wait for setups that meet all 4 factors. View losses as lessons, not failures. Suggestions to move forward and use this book. Effectively, to truly benefit from Miner's teachings. Practice consistently in a demo or small live account before scaling up. Develop patience. Wait for the full confluence of price, pattern, time, and momentum. Create a personalized trading plan using Miner's framework and commit to it daily. Review and journal every trade to learn and grow. Keep your emotions in check. Remember, discipline wins over impulses. Continuously study market behavior and adapt. Trading is a lifelong journey. Final thought, trading as a journey. Not a sprint. Miner reminds us that trading success doesn't come overnight. It's a process of learning, practicing, and refining. With a solid plan, you're not chasing the market. You're steering your own course. And that's how ordinary traders become consistently profitable professionals. So here's a question for you. Are you ready to build your own roadmap and commit to disciplined trading? Because the difference between dreaming and doing is a plan and the courage to follow it. And there you have it. Robert C. Miner's high-probability trading strategies broken down into practical, actionable steps that can transform the way you trade. Remember, success in trading isn't about chasing every signal or trying to predict the unpredictable. It's about mastering a disciplined process that combines price, pattern, time, and momentum. With the right plan and mindset, you can trade with confidence and consistency. If you found this summary valuable, make sure to hit that like button and subscribe to Book Loom for more insightful book breakdowns designed to boost your knowledge and skills. Now, I want to hear from you. What audiobook or trading book should we dive into next? Drop your suggestions in the comments below, and let's keep learning together.
Fucking around, I could cry, no. I ain't tryna tell you what to do, but tryna play cool. Baby, I ain't playing by